Addressing these challenges necessitates a more nuanced approach to capturing investor emotions, one that goes beyond basic sentiment classification to encompass a wide range of emotional states. There is a clear need for comprehensive datasets that provide fine-grained annotations of investor emotions, enabling more detailed and accurate sentiment analysis. Such datasets would empower researchers to explore the intricate relationships between specific emotions and market movements, thereby enhancing the predictive power of financial models. Understanding investor emotions has emerged as a pivotal factor in financial sentiment analysis and stock market prediction, offering deeper insights into market dynamics beyond traditional numerical data. This article delves into the integration of nuanced investor emotions into financial analytics, underscoring their significant role in shaping market behavior and investment decisions. To facilitate this, we developed a comprehensive dataset, meticulously curated from StockTwits, a prominent financial social media platform. This dataset encompasses over 10,000 English comments, each annotated with both binary financial sentiments, bullish and bearish, and 12 fine-grained emotion categories inspired by behavioral finance and psychological theories. Our annotation pipeline employs a sophisticated multi-step process that synergizes human expertise with advanced pre-trained language models, ensuring high-quality and contextually accurate emotional labels. Leveraging this dataset, we implemented a series of advanced machine learning models to perform financial sentiment classification and multivariate time series forecasting. Our experiments revealed that emotion-enhanced models, particularly those utilizing DistilBERT, significantly outperform traditional baselines in sentiment classification, achieving an average F1 score of 0.81. Furthermore, in predicting the S&P 500 index, models incorporating emotional features alongside textual and numerical data demonstrated superior accuracy, evidenced by a notable reduction in mean squared error, MSE. These findings highlight the profound impact of investor emotions on market predictions, suggesting that incorporating emotional intelligence into financial models can enhance forecasting accuracy and provide a more holistic understanding of market trends. In recent years, the convergence of natural language processing, NLP, and finance has revolutionized the way market dynamics are analyzed and understood. NLP techniques enable the extraction and interpretation of vast amounts of textual data from diverse sources such as social media platforms, financial news, and analyst reports. This integration facilitates the identification of patterns and sentiments that influence investor behavior and, consequently, stock market movements. As financial markets become increasingly interconnected and influenced by real-time information dissemination, the ability to accurately gauge investor sentiment and emotions has become paramount for both academics and industry practitioners aiming to predict market trends and make informed investment decisions. Understanding investor sentiment and emotions is critical in deciphering the complexities of stock market dynamics. Emotions such as optimism, fear, and anxiety can significantly impact trading volumes and price volatility, often leading to market anomalies that are not explained solely by fundamental financial indicators. Behavioral finance, a field that blends psychological theories with economic behavior, underscores the profound effect of investor emotions on market outcomes. By analyzing the sentiments expressed by investors, it is possible to gain insights into market sentiment shifts, identify potential investment opportunities, and mitigate risks associated with emotional-driven market fluctuations. The foundation of any robust financial sentiment analysis and market prediction model lies in the quality and comprehensiveness of its underlying dataset. To address the limitations of existing financial sentiment datasets, we embarked on the creation of a novel dataset meticulously curated from StockTwits, a specialized social media platform dedicated to financial discussions. StockTwits serves as a vibrant hub where investors, traders, and financial enthusiasts converge to share insights, opinions, and real-time information about various financial instruments. Unlike more generalized platforms such as Twitter, StockTwits is inherently focused on finance, making it an ideal source for collecting relevant and concentrated financial discourse. The selection of StockTwits as the primary data source was driven by several compelling factors. Firstly, StockTwits hosts a highly active and engaged user base that consistently generates a substantial volume of content centered around stock market discussions. This active participation ensures a steady influx of data, providing a rich repository of investor sentiments and emotions. Secondly, the platform's structure, which incorporates features like cash tags, e.g., $TSLA, and predefined sentiment labels, bullish or bearish, facilitates the extraction of targeted financial information. These inherent features not only streamline the data collection process but also enhance the relevance and accuracy of the collected data for subsequent analysis. Data collection for the dataset spanned a full calendar year, from January 1, 2020, to December 31, 2020. This timeframe was strategically chosen to capture a period marked by unprecedented market volatility and emotional turbulence due to the COVID-19 pandemic. The global health crisis induced significant fluctuations in financial markets, making it a fertile ground for studying the interplay between investor emotions and market dynamics. Over the course of the year, we amassed a substantial volume of data, comprising more than 10,000 English-language comments. These comments were sourced from discussions surrounding over 80% of the S&P 500 companies by market capitalization, ensuring broad coverage across major financial instruments and sectors. This extensive coverage not only enhances the dataset's representativeness but also ensures that the findings derived from the analysis are generalizable across various market segments. The raw data collected from StockTwits underwent a rigorous pre-processing pipeline to ensure its suitability for sentiment and emotion analysis. A critical aspect of this pre-processing involved user representation. To mitigate potential biases and ensure a fair representation of diverse investor perspectives, we imposed a restriction of 1 comment per user per day. This approach prevents overrepresentation of highly active users, thereby maintaining the dataset's balance and enhancing its overall reliability. Noise in social media data, such as advertising, spam, and irrelevant content, poses significant challenges to accurate sentiment analysis. To address this, we implemented a filtering mechanism that systematically removed advertising or commercial content. This was achieved by identifying and excluding comments from commercial usernames and detecting specific text patterns indicative of promotional content. By applying these heuristics, we ensured that the dataset predominantly comprised genuine investor sentiments and discussions, thereby enhancing the quality and relevance of the data. Tokenization and length filtering constituted another essential step in the pre-processing pipeline. Utilizing the Natural Language Toolkit, NLTK, we tokenized each comment to break down the text into manageable units of analysis. To retain meaningful context and eliminate noise from excessively short or repetitive comments, we enforced a minimum threshold of 4 unique tokens per comment. Additionally, to ensure compatibility with advanced language models like BERT, we set an upper limit of 512 tokens per comment. This length filtering is crucial as it balances the need for contextual richness with computational efficiency, ensuring that the dataset remains both informative and manageable for downstream tasks. A significant challenge in processing social media data is the presence of specific entities such as cash tags, e.g., $TSLA, hashtags, e.g., hashtag market, and URLs, which can obscure the underlying sentiment and emotion. To address this, we employed a masking strategy where these entities were replaced with standardized tokens, CTAG, for cash tags, HTAG, for hashtags, and URL, for website links. This normalization process not only preserves the structural integrity of the comments but also ensures that the models focus on the substantive content rather than being distracted by these entities. Furthermore, any comments composed solely of masked tokens were excluded from the dataset, as they lack meaningful textual information necessary for sentiment and emotion analysis. Annotation pipeline, the accuracy and reliability of any dataset, particularly one designed to capture nuanced emotions, are fundamentally dependent on the robustness of its annotation process. To ensure that our dataset authentically represents the diverse spectrum of investor emotions, we implemented a meticulous multi-step annotation pipeline that integrates human expertise with advanced machine learning techniques. This comprehensive approach not only enhances the quality of the annotations but also ensures scalability and consistency across the dataset. Seed dataset creation. The first phase involved the creation of a seed dataset, which comprised approximately 30% of the final dataset. This subset was carefully selected to ensure a balanced representation of the 2 primary financial sentiment classes, bullish and bearish. Achieving this balance was crucial for training a reliable classification model. 3 seasoned financial experts were tasked with manually annotating this seed dataset. Their expertise ensured that the annotations were not only accurate but also contextually relevant to the financial domain. To measure the consistency and reliability of the annotations, we calculated the interannotator agreement using the Cohen-Kappa score, achieving a commendable score of 0.79. This high level of agreement indicated that the annotators had a shared understanding of the emotion categories and were applying them consistently across the dataset. Such a strong agreement is indicative of the clarity and effectiveness of the defined emotion taxonomy, laying a solid foundation for subsequent automated labeling processes. Model training. With the seed dataset in place, the next step involved training a BERT-based multi-class classification model. BERT, bidirectional encoder representations from transformers, is renowned for its ability to understand context in text data, making it an ideal choice for emotion classification. The model was fine-tuned on the manually annotated seed dataset, enabling it to learn the intricate patterns and nuances associated with each of the 12 defined emotion classes. This fine-tuning process adjusted BERT's pre-trained parameters to better suit the specific task of emotion detection within financial texts, ensuring that the model could accurately differentiate between subtle emotional expressions. Automated labeling. Once the BERT model was sufficiently trained, it was employed to automate the labeling of the remaining 70% of the dataset. This phase involved applying the trained model to unlabeled comments, thereby generating initial emotion labels at scale. To capture temporal variations and ensure that the dataset reflected the dynamic nature of investor emotions over time, we implemented a strategy to maintain proportional representation across different months. This temporal stratification was essential for capturing shifts in investor sentiment that may correspond to significant market events or broader economic trends, thereby enhancing the dataset's comprehensiveness and relevance. Human validation. Despite the high performance of the BERT model, human oversight remained indispensable to ensure the accuracy of the automated labels. In this phase, human annotators reviewed a subset of the model-generated labels, particularly focusing on instances where the model exhibited lower confidence or where the text contained ambiguous emotional cues. Annotators were responsible for either accepting the model's labels or revising them to better reflect the true emotional context. This human-in-the-loop approach not only corrected potential errors but also provided additional annotated data, which was used to further fine-tune and improve the BERT model. Through iterative refinement, the model's labeling accuracy was progressively enhanced, ensuring that the final dataset maintained high standards of quality and reliability. Emotion taxonomy development. A critical component of the annotation pipeline was the development of a comprehensive emotion taxonomy. Drawing inspiration from behavioral finance and psychological studies, we defined 12 fine-grained emotion classes, including optimism, excitement, anxiety, and disgust. This taxonomy was meticulously crafted to capture the multifaceted emotional states that influence investor behavior, moving beyond the simplistic binary sentiment labels of positive and negative. The 12 emotion classes were selected to provide a detailed and nuanced understanding of investor sentiments. For instance, optimism and excitement are often associated with bullish sentiments, reflecting positive expectations about market performance. Conversely, emotions such as anxiety and disgust may correlate with bearish sentiments, indicating concerns or negative outlooks. By defining these specific emotion categories, we aim to capture the diverse emotional landscape that drives investment decisions and market dynamics. Data analysis. A comprehensive analysis of the dataset is essential to uncover underlying patterns and insights that inform the relationship between investor sentiments, emotions, and market behaviors. This section delves into the descriptive statistics, emotion correlation analysis, and emoji usage within the dataset, highlighting key findings and their implications for financial sentiment analysis. Descriptive statistics. The dataset comprises a balanced distribution of financial sentiments, with 55% of the comments classified as bullish and 45% as bearish. This near-even split ensures that the analysis captures both optimistic and pessimistic investor perspectives, providing a robust foundation for sentiment classification and market prediction models. Within these sentiment classes, the distribution of emotions reveals significant imbalances. The most prevalent emotions include optimism, 16%, and excitement, 14%, which are commonly associated with bullish sentiments, reflecting positive expectations and enthusiasm about market performance. Conversely, emotions such as depression, 2%, and panic, 3%, are notably underrepresented, often linked to bearish sentiments and indicative of investor anxiety and fear during market downturns. The average length of comments in the dataset is approximately 19.2 tokens per utterance, suggesting that the majority of investor expressions are concise yet informative. This brevity is characteristic of social media communications, where users convey sentiments and opinions succinctly. Additionally, the dataset showcases a diverse array of 761 unique emojis, underscoring the multifaceted ways in which emotions are expressed visually alongside textual content. The integration of emojis adds an extra layer of emotional depth, enhancing the ability of models to accurately interpret investor sentiments. Emotion correlation analysis. Understanding how different emotions co-occur provides valuable insights into the complex emotional landscape of investor behavior. A correlation heat map constructed from the dataset reveals several notable patterns. Strong positive correlations are observed between optimism and excitement, indicating that positive market sentiments often coexist with high enthusiasm and confidence among investors. Similarly, emotions such as anxiety and confusion show a positive correlation, reflecting periods of uncertainty and stress during volatile market conditions. Conversely, negative correlations emerge between emotions like anger and belief, suggesting that heightened frustration may undermine investors' confidence or conviction in their investment decisions. These inverse relationships highlight the dynamic interplay between different emotional states and their impact on market behavior. Additionally, the analysis identifies a prevalence of teasing within the comments, which is frequently labeled as either ambiguous or discussed. This trend underscores the nuanced and sometimes contradictory ways in which emotions are expressed, particularly in response to others' investment losses or market events.